Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking the time out of your busy day to spend some time with us. We have an amazing show for you this afternoon. A fantastic guest, Catherine Cobden, President and CEO of the Canadian Steel Producers Association. She's going to shed some light with us on what's happening right now in the steel industry. We've heard of 50% tariffs that have now been announced by the United States on steel imports to the U.S. That, along with 50% tariffs on copper, 50% tariffs on aluminum. And right now, we here in Canada are feeling the pinch, right? These tariffs are definitely hitting home. Speaking to Catherine, as I did this past week, and we're going to bring you that interview shortly, you can really see how these tariffs are biting right now. Steel industry is trying to figure out what they need to do to continue to do business in the U.S., perhaps try to do business elsewhere, and perhaps even stir up some more growth within our country so that domestically we can use up more of the steel that we produce. So fascinating interview, and we have that for you today. But along with that interview, we have a number of topics as well. An interview with Catherine Cobden, President and CEO of the Canadian Steel Producers Association. As I mentioned, we will have her interview off the top of the show. Then we'll get into our usual top three things to consider over the next 5 to 10 business days before you make your investment decisions. A fan favorite of our show, opportunity to hear what I think is important and what individual investors should be focusing on. Our third topic, the Federal Reserve and Bank of Canada rate decisions, I should say, not necessarily a cut, will happen now on Wednesday, July the 30th. Both Bank of Canada and Federal Reserve will make announcements that day, which is unusual. Normally we get one of the central banks, but very rarely do we get both central banks making rate announcements. And I'll tell you what I think they should be doing at this time, and figuring out, from how they've been talking over the last, let's call it few weeks now, well, even few months in the case of the Federal Reserve, giving us indication as to how they think things are going with respect to the economy in the U.S. And right now, we'll hear what they have to say come July the 30th. NVIDIA is getting to resume chip sales in China, and not just their latest chips, but their H20, their H20 chips, which is, as we know, not their most recent chip, not their most powerful chip, probably 2 or 3 chips ago, or older chips that they produced, many months ago now. NVIDIA is getting the green light to sell those chips back to China. And as we know, I guess now it's been probably a few months, NVIDIA took a hit on these chips. They had to write off the cost of these chips and everything that went into producing these chips for China. The United States said at one point, or not too long ago, they couldn't sell these chips to China. So they took a write-off, but now they're able to do so. So not sure if the old chips were thrown out or given to somebody else, but we'll find out what NVIDIA is going to do. Investors seem less rattled by higher inflation and higher tariffs, or at least the announcement of tariffs. Back on April, when we heard that these reciprocal tariffs, as President Trump called them, when they were announced, the market really took it on the chin. Now we're hearing about letters that the president is sending out to countries like Canada, for example, announcing different tariff rates. And instead of the market falling because of that, the market seems to be climbing this wall of worry and hitting new highs on a regular basis. Couple that with the inflation rates moving slightly higher, getting closer to 3% once again in the U.S. Back again a few months ago, earlier in the year, that would have caused the market to also move lower. But today we just seem to keep hitting new highs. So tariff rates, higher inflation just doesn't seem to take this market down. We will talk about that as well. Quick hits, 3 things that have been in the news over the last, few weeks that I'm sure many of you have seen. I will comment on all 3. And last but definitely not least, your questions that you may have with respect to the show today, questions you have with respect to your portfolios, the markets, the market in general, the environment for investing, anything you have, please put it into the chat boxes while the show is happening. I would be happy to answer your questions either at the end of the show or on our next show, or perhaps during the 2-week period before our next show. So without further ado, let's move on to a fantastic interview with President and CEO of the Canadian Steel Producers Association, Catherine Cobden. I'd like to welcome to our show Catherine Cobden, President and CEO of the Canadian Steel Producers Association, the national voice of all primary steel producers, representing 17 members that produce 100% of Canada's steel production, as well as some of the largest users of Canadian steel. Catherine has been with the CPSA since 2019 and previously had been an executive vice president with the Forest Products Association of Canada. Catherine has been named one of the top 100 lobbyists by the Hill Times newspaper for the past 4 years. I want to welcome to the show, Catherine. Thank you for being here with us.
Hey, thank you very much for having me.
No, and obviously a lot of news coming out. We just talked before we came on air here about the changes just yesterday. We were talking that some positive change, so that's a good thing. And we'll get into that a little later in our conversation. But I thought we'd start off putting some perspective on some numbers, some of the numbers so that the viewers and listeners can get a sense of how much steel we do produce and send to the United States and elsewhere. So I guess my first question would be, how much steel do we export to the U.S. or did we export to the U.S. before tariffs were implemented? What percentage of the steel we produce goes to the U.S.?
Yes, about 1/2 of what we produce. So that would be about 6 to 6.5 million tons of steel on an annual basis went to the United States market before the U.S. president applied tariffs on our industry.
And what would that make up on the U.S. side? So out of the steel that they bring into their country, do you know what percentage we would make up here in Canada?
Yeah, it's a little over 20% of their imports. So the interesting part of the Canada-US steel story is that the United States is about 26 million tons short of steel. In other words, they don't produce 26 million tons and do need to rely on imports. Canada is the largest steel importer into their country. And as I said, that was about 6 million tons of that 26 million, which is a little over 20%.
So I guess my question, or next question, maybe it's an obvious question: how can the U.S. I guess survive these price increases? Obviously, 20% is a big number. What does that mean to U.S. businesses, to end users? I know that since the tariffs have been put on steel coming into the U.S., even domestic steel prices and production, their prices have gone up quite a bit as well. You're hearing stories of the U.S. And producers actually bringing in from other places in the world, because even if you factor in the tariffs, it's still cheaper paying a 50% tariff than some of the prices that we've seen in the U.S. So how is it that the president can believe that the U.S. can survive such a higher cost, even coupled with copper prices, 50% tariffs, aluminum, 50% tariffs? Can you give us an indication of what they're telling you? How can they actually get by?
Well, listen, I think that there is no doubt that the tariff regime that the U.S. president has placed on steel globally is increasing prices. So first fact is that steel, since the introduction of the 232 tariffs on steel, even the beginning one in March at 25%, we have seen a 40% rise in hot rolled coal prices, which we use as a proxy for steel prices, as of course, there's many steel prices, but a 40% rise is definitely significant. I do, appreciate that the Trump administration is very, tied to their tariff regime. But I will say that the questions you're asking are real, are pragmatic. I mean, we do have a deficit of steel that the U.S. requires imports to supply, and we are seeing these rising prices. So obviously, in the case of the Canadian industry, even with that price rise at 50% tariff, it's no longer a viable market for us. For other importers into the United States, however, they are often unfair traders that dump into that market. They will have the ability to continue to dump at 50% tariffs. So that's the conundrum, is that the tariffs are actually impacting the fair trading partners more than the unfair trading partners, so to speak.
Yeah, it's I guess a lot of dumping we've been hearing, obviously countries like China dumping steel into North America in general, I guess for many years. I want to go back to Canadian production, and you mentioned 50% goes to the US. I guess the obvious question again is, where does the other 50% go? And is it all consumed domestically? Do we send steel to other countries? And I guess the next question is, can we increase that? Can we send more to other countries?
Yeah, so 50% of our production heads to the United States. The other 50% resides in Canada, pretty much. I mean, there's a small percentage, I think less than 0.1% goes to Europe, for example. So we are not, we really only serve two markets, the Canada and the United States. So clearly that's one of the challenges we have now with the 50% tariff, is we've lost market for half of our production. So that is what's been creating the devastating impact in the industry, because we can't, to anticipate the question, we can't pivot to other markets, unfortunately, maybe in small niche areas. But on the big commodity steel products, there is a global oversupply, predominantly out of China, as you've mentioned. So, when you have such a glut of steel in the marketplace, building new markets becomes extremely difficult.
So, I know in every business, I talk to a lot of small businesses, my own business as well. Whenever you rely heavily on one customer, where all your eggs are kind of in one basket, obviously that can be at a certain point in time a recipe for disaster, which I guess we're seeing now. We thought our brothers to the south would always be, I guess, there buying steel, buying copper, buying aluminum, buying our products. I guess the country as a whole sending about 70% of what we take out of the ground and build to the US. Do you think we've just been a little complacent, not trying to do more, not trying to send our steel elsewhere? You mentioned there's a glut in the world, but is it just we just relied on the US for too long and too much?
Well, structurally, we created an integrated economy with the United States. And so we can't forget that. And we have been under free trade agreement with the CUSMA partners. It's now USMCA or, partners, but of course there's NAFTA before that, what have you. So we've had decades of integration. And certainly on behalf of the steel industry, I can say that North American partnership has created significant benefit to Canadian and US steel industries alike. So it was a natural partnership facilitated by the free trade agreements between our countries. So that's what we're unraveling here, is decades and decades of integration. So, I don't call it complacency. I call it it was a win-win scenario for both countries. Clearly, that is not the direction the US wants to maintain. They want to go it alone and, unravel those strong trading relationships. So then it requires us to pivot and change our approach. But, in this, I understand theoretically the point you're making, but for us, it really became a position of strength to operate as a North American sector. We got a lot of benefit from that. Now we're standing on our own.
Standing our own, yeah. And I know obviously the Prime Minister just yesterday made some great announcements on our own tariffs on countries bringing steel into Canada. But it kind of makes me wonder, what can we do to help our situation? Obviously, I know the Prime Minister has also said that there will be some form of tariff, that he believes there'll be some form of tariffs on Canada, between Canada and the US, even after negotiations are complete. So based on what you're saying, that the 50% stays domestically, 50% goes to the US, perhaps pro-growth strategies from our government trying to do whatever they can do to create more growth in our country. Would that be the way, I guess, I don't want to say out of this situation because I think it's going to take a while to do that, but pro-growth, perhaps lower taxes, perhaps do certain things to allow businesses to do more, to grow more, allow for bigger projects that require steel, require aluminum and copper and things like that. Would that be a suggestion that someone has made to the Prime Minister to help us get out of, or at least work our way out of this situation?
I mean, I think we see that as the vision of the Prime Minister. In fact, he's talked about nation building. He's talked about in that nation building, prioritizing domestic supply chains, including steel. So I think all of that is in play, frankly. And yesterday we saw some steps forward for the procurement of steel, domestic steel in domestic projects and that kind of thing. But to your point, it's all about timing. And I think we all know, for those of us that have been in the, exposed to resource sector projects in our careers, we know it takes a long time. And I'm personally admiring, the notion of trying to do these things faster. We got a lot of, navigation to do. It's really important to consult and that sort of thing. But so that's the issue. I think the vision is there, but it's how do you get from where we are today to the vision? And that's where those measures came into play for us. I described it yesterday as we were bleeding out on the table. And so the supports and the border measures create immediate and impactful support. It doesn't by any stretch of the imagination, by the way, offset the 6 million tons that we've lost. In the best case scenario, we might get we might get 2 million of new opportunity in our country, but nonetheless, that's 2 million we welcome, because that was 2 million we didn't have 2 days ago, right? So all that to say, the longer term vision of nation building using domestic supply chains and domestically created materials and supporting domestic jobs is what I think I'm hearing the Canadian government articulate at this moment in time.
Yeah, and as you said, any bit helps at this point when we're kind of fighting a bit of an uphill battle. So now that we have the 50% tariffs obviously in place, what does that mean for the steel industry here? Do you anticipate a lot of layoffs, more layoffs than we've already seen? What are you envisioning going forward?
Yeah, and I think I think the basis of the government's decision making has been just how negatively impacted the steel sector has been in Canada to Donald Trump's 50% tariffs. We have seen, since between March and May at 25%, we saw significant job losses and production curtailment. And in fact, we just got the May figures where we showed a 30% decline in production of steel nationwide. That's at a 25% tariff. But since June, we've been operating under a 50% tariff. So you can imagine, we don't have the public and official data sources of this yet because the data lags, but we can see our order books. They look like a war zone. There is not much there. So it was really desperation for us, and we are in desperate times. And we are still desperate, but we are more hopeful today than after the announcement yesterday of the new border measures.
I guess I want to end off with kind of a general question where we kind of started our interview, and that is, what impacts would the tariffs mean outside the steel industry? For those that are watching this show today and listening on the radio, what does it mean for outside the industry? Because I'm assuming there's a lot of people now saying, well, I don't work in the steel industry, this won't impact me. How does this impact Canadians, Ontarians? How does it impact all of us?
Yeah, well, certainly several things to say there. One is that the industry is a strategic industry for the country, in the sense that we play a really critical role to supporting the auto sector, the energy sector, the construction sector, the defense sector. I mean, if you're listening and you work in any sector that, requires steel in any form, we are a strategic partner in your job, frankly. So there is definitely that. I will say that we know that Canadians might also be worried about supply chain disruption if we're suddenly taking on, foreign entities that have been practicing unfair trade. My call to Canadians on this at this moment in time, though, is yes, there might be slightly higher prices, maybe not in the length of the project, by the way, but in the short term, in the immediate term. But the facts of that unfair trade are that they don't follow the rule of law. They have very, very poor labor practices. They have maybe no environmental standards, or if they do have standards, they're very poor. And in the Canadian context, we have, really, really good wages, really good, environmental track records, et cetera. So we have to make some choices. Is it all just going to be price, or are we going to have the bigger picture about our country in mind as we make our steel purchases?
Yeah, a lot of valid points. Steel touches many industries. You mentioned just a few: automotive, defense, two that come to mind for sure. So, Catherine Cobden, President and CEO of the Canadian Steel Producers Association, CPSA. Thank you so much for taking the time to talk to us. I know you're a busy lady these days. I'm sure you'll continue to fight on our behalf and see what we can do. And hopefully the Prime Minister will be able to come up with a deal that can help all of us. So once again, thank you so much for being on our show today.
Thank you very much for having me.
All right. Bye-bye.
Bye-bye.
What a fascinating interview. Catherine was fantastic. She's very busy at this point in time, as you can imagine, lobbying the government, talking to the government, representing 17 largest steel producers in Canada. You can imagine very busy days that she's having right now, but she took the time to speak with us and give us the lay of the land, telling us what's going on. And right now, things seem quite dire, unfortunately. At least that's what Catherine has been telling us. Has told me even off camera that things are challenging. She's hoping that a deal can be made between Canada and the U.S. to help our steel producers. So we'll have to see what happens. Perhaps we'll have Catherine back on at a later date. Now, the part of our show where we discuss three things that I think are important for individual investors to consider before you make your investment decisions. And here you have three of them right now in front of you: trade deals and announcements. As we know, right now, President of the United States, along with Treasury Secretary Bessent and Marco Rubio and all of the individuals that are part of the administration, Jameson Greer, part of the trade team, trying to come out with trade deals between the United States and really the rest of the world. This is what we're talking about right now, what we've been talking about for quite some time. So once again, something to keep top of mind. Our second point, corporate earnings update. Corporate earnings season has kicked off over the last, let's call it, week or two, starting with the big banks in the United States, but now working their way to some of the big tech earnings as well. We've seen some big tech earnings coming out. We will get some more tech earnings this week. Names like Tesla and Google, some of the Mag 7 names will be reporting shortly. And we'll talk about how the corporate earnings season has fared so far. Managing expectations. Now, this is an interesting one. We've had this as a topic to focus on before. Here we are, right? Markets at our all-time highs. We are getting close to the end of July, and we'll be getting into August pretty soon. Historically, the months of August and September are challenging months for the stock market more often than not. And when you come in on a high, near all-time highs, 52-week highs, sometimes the market can struggle. With individuals talking about things such as, is the market overvalued at this point in time, or at best fairly valued? and should we continue to see the growth that we've been seeing. So managing investors' expectations, managing your own investing expectations. Should you expect a bit of a pullback towards the end of August, beginning of September? It's quite possible. We'll have to see how the economic data plays out. We'll have to see how the tariff situation plays out, and a number of other factors will set the tone for the markets. So let's move on to our first topic, trade deal and trade deal announcements. So we know that it's been, or that it is about 1 week away, maybe a little bit more than a week away, August 1st. That is the deadline for tariffs, for the tariffs that the president has put back on many countries now. For those that haven't received their tariff rate as yet, haven't received the letter as yet, I believe the president is going to send kind of a blanket letter to the rest of the countries. I think that the U.S. has already sent a letter to their major trading partners. We have already heard what the tariff rates would be in places like the EU, places like Japan, South Korea, Canada, Mexico, the major trading partners for the United States. And these tariffs look to take place or to start as of August 1st. We've also heard tariffs on steel, aluminum, as we know, copper as well. So these sectoral tariffs on top of the country-specific tariffs. So we could actually see rates significantly higher in the coming days. And I guess overall, as an investor, you really want to, I guess, have one eye or ear on what's going on, what's coming out of Washington. You want to know whether a deal has been made. We've heard of deals with places like Vietnam, places like the UK, but we really haven't seen much in the way of deals with the U.S. as major allies or trading partners. In Canada, we're working towards a deal before August 1st, and the hope is that we can get one. I know Prime Minister Carney has said that even if we get a deal with the U.S., it'll probably involve or still involve tariffs placed on what we send to the U.S., imports into the U.S. from Canada. It may be as low as 10%, 15, 20%, but there will still be a tariff, which I know Canada obviously is not too happy about. Our first chart here, we can take a look and see here. This shows you all the different tariff rates that the U.S. is now talking about implementing on different countries as of August 1st. You can see right off the top, Indonesia, 19%. That deal has been, I think, announced most recently. Vietnam, 20%, used to be 46%. So the number on the left side was where it was beginning of April, and the new rate as of today. United Kingdom, the UK, even though they have struck a deal with the US, doesn't appear that their tariff rates have gone down any. It was 10%, and it is still 10% with the US. European Union, once upon a time, 20% as of April. Today, we're talking 30%. Mexico, Canada, as much as 35%. So you can clearly see here how the United States, in some cases, has actually put on higher tariff rates on certain countries than they had back at the beginning of April. Places like Japan at the bottom of our chart there, 25% tariff. In April, it was 24%. And Malaysia, 25%. And back in April, it was 24%. So, places like a European Union, we've heard them talking about how with that high of a tariff placed on Europe, if it were to go through on August 1st, that could possibly prevent the two regions, or I guess I would say countries, but as we know, the European Union is made up of 27 countries, but the European Union as a whole, preventing them from doing any kind of trade with the U.S. just in general. They're talking about with these high tariff rates, that could prevent all trade from happening. And, they said that, but yet again, the market didn't really respond. I think the market is anticipating a trade deal done between the U.S. and Europe. I think the market is anticipating a deal done between many countries, many of the United States' big trading partners and allies. And I think that's why we haven't really seen the market go down too much as yet. Recently, we saw a copy of what the President of the United States sent to Canada. It was a letter the same letter that he has sent out to many countries. We actually have a copy of that letter we can actually show. There it is. I won't go through the whole letter, but President Trump starts off by saying, very politely and respectful, it has been a great honor for me to send this letter in that it demonstrates the strength and commitment of our trading relationship. Well, I don't know if Canada would think that that is the case, or any other country for that matter. It goes on to talk about, why the tariffs are being placed on Canada, whether it's fentanyl or whether it's because of, I guess, not allowing the U.S. to move into some of our markets, like the dairy markets. And at one point, the U.S. was upset about digital services tax, which has now been taken off. So there are a number of things that President of the United States was not happy with, as he says, not allowing us or not allowing the U.S. to get into our markets, having a deficit with the U.S. As we know, that's not necessarily the case. If you take away the energy component of that deficit, the U.S. is actually at a bit of a surplus. So a lot of the deficit was just mainly because of energy and because of oil. But that was the letter that the president sent to us. And one of the parts at the end, it says that if Canada were to reciprocate, were to increase tariffs on the U.S., then the U.S. has the right to increase further tariffs on Canada by as much as whatever Canada puts on the U.S. So basically, if we put 30% tariffs on the U.S., then tariffs will be increased by 30% more. So that's in that letter as well. We have a recent comment from Prime Minister Carney. You can see here, I believe this was on X, on Twitter, and he writes, throughout the current trade negotiations with the United States, the Canadian government has steadfastly defended our workers and businesses. We will continue to do so as we work towards the revised deadline of August 1st. He goes on to say, Canada has made vital progress to stop the scourge of fentanyl in North America. We are committed to continuing to work with the United States to save lives and protect communities in both countries. We are building Canada strong. Federal government and provinces and territories are making significant progress in building one Canadian economy. We are poised to build a series of major new projects in the national interest. We are strengthening our trading partnerships throughout the world. And we know that that's the idea, right? That's what Canada is trying to do. They're trying to forge relationships with other countries around the world. We're already hearing that things such as natural gas are being exported to places like Asia. So we are definitely trading less with the U.S. and trading more with other parts of the world, which is a great thing. And as I said, as investors, you want to keep an eye on what comes out of these trade negotiations, what the trade announcements are, and what Canada is going to be doing over the coming weeks. Our second topic that individual investors need to focus on before you make your investment decisions is this corporate earnings season. All the different corporations and businesses will report how they did in calendar or quarter two of 2025. How is business going? How are some of these businesses faring? And right now, for the most part, we've seen most of the major banks in the United States, big and some of the kind of mid-tier banks report earnings. Some of the regionals, super regionals, as we call them, have reported earnings, the PNCs of the world, for example. And for the most part, bank earnings season has kicked off in fine fashion. We've heard from companies like, for example, JP Morgan. We have a chart of JP Morgan, and they say that JP Morgan is doing just fine. A lot of money is being made. A lot of businesses are going public once again. JP Morgan is making a lot of money on trading, wealth management, lending once again. And their stock, as you can see, has definitely reflected what's going on with respect to JP Morgan, trading near or at all-time highs. And as I said, with a lot of trading in the IPO market going strong, or at least opening up again, things are going really well. Second bank stock I wanted to show, and this is Goldman Sachs, the chart of Goldman Sachs. When you hear of trading, investment income, IPOs, you got to look at Goldman Sachs, right? They're the leaders and biggest investment firm basically around. And when you hear about IPOs, companies going public, trading revenues, this only helps Goldman Sachs. We see there their chart has been sort of flat, kind of flatlining near 52-week and actually all-time highs. And if you've held shares of Goldman Sachs, you've done extremely well. And corporate earnings season, as I said, was not a disappointment from the likes of Goldman Sachs or even a Morgan Stanley, another investment firm, or any of the major banks, Citibank, JP Morgan, Bank of America, Wells Fargo. All the major banks have done extremely well. A couple of tech names that have recently reported as well. We'll go to our first chart on tech, which is Taiwan Semiconductor. Taiwan Semiconductor, for those of you that don't recognize the name, Taiwan Semiconductor is the largest chip manufacturer in the world today. Now, if some of you are saying, I thought that was NVIDIA. Well, NVIDIA creates the chips, and Taiwan Semi makes and builds the chips for companies like NVIDIA, companies like Apple, companies like AMD, and many other chip makers or chip creators, if you want to call them that. Taiwan Semi is the one that puts it all together and builds the chips for these companies. And they just reported earnings. Earnings were unbelievable. Growth in really stemming from AI, as you can imagine, data center, AI, growing earnings at a rapid rate, continuing to impress, continuing to take up expectations for future earnings. The stock just doesn't seem to quit. And the interesting thing for me for this stock is that no matter how well it has done, compared to some of the other names in the same space, like an NVIDIA now trading at 40 times earnings, or an AMD trading at 40 times earnings. These are forward earnings, I should say, forward earnings, earnings multiples trading at 40 times. TSMC, or Taiwan Semiconductor, is trading at just 24 times forward earnings. So I believe still can be looked at and still cheap or cheaper relative to some of these chip makers that many of you own today. Another tech name that we've grown to love over the last, I guess, few years now is Netflix. Now, this name is very interesting. You'll see here that the chart has had a good run, but somewhere around, let's call it third week of July, or sorry, not third week, but I guess third week of June, I should say. See the stock kind of selling off a little bit. Netflix beat on the top line, beat on the bottom line, earnings per share. The problem with Netflix is it has done so well that the expectations are just so high. And when you have a name like Netflix coming into an earnings report where expectations are very high, it is so difficult to meet those expectations. And what we saw with Netflix on the day they reported is we saw a bit of a sell-off in the name. Their subscriber growth was good, their earnings were good, their revenues were good. Their expectations going forward was a little disappointing, I think. I think some people wanted to see it a little bit better. But nonetheless, Netflix is firing on all cylinders. And it's just coming into this earnings report, I just think the expectations were far too high for a name like Netflix. And I think that's why they were, a name that unfortunately didn't see a pop, even though many other names that have done just as well, or maybe not even as well as a Netflix, we saw their names move higher. So earnings season, earnings reports that are going to continue to come out. As I said, we're going to see the Mag 7, Tesla, Google coming out shortly in the next day or so. And these are companies that obviously we want to keep an eye on, the Mag 7 being such a huge part of the growth of the markets, of the economy right now. So earnings and earnings season is something investors want to keep an eye on. Our third point, or our third topic for individual investors to focus on, is this idea of managing expectations. And we talked about that off the top of the show. And, coming into this time at the end of July, July being one of the best months of the year, if you can believe it, for investors' returns, well, August and September are usually not such great months. And our first chart shows the S&P 500. We can see how well the S&P 500 is doing coming into August. As there we have it. You can see how it's clearly gone from the bottom left to the top right, from about middle of April to present day. There's a year-to-date chart. We are pretty much at all-time highs on the S&P, over 6,300. I know that the market has been a little bit volatile. This chart was taken actually yesterday. And so, it doesn't take into consideration how the markets closed yesterday and how the markets have fared this morning. So overall, S&P 500 coming into August on a high note, most definitely. Our next chart here shows the different sectors of the S&P 500, and you can see how many of the sectors are in the red. If you look at the middle column, YTD or year to date, you can see that communication services up almost 11%. Information technology in the middle of the chart there, 11.88%. Utility sector, which is interesting. That's, I think, a lot to do with data center and all the energy that is needed to power these data centers. Perhaps that is causing the utility sector to move higher. They're up by almost 11% as well, but only a few sectors, right? Consumer discretionary, names like Nike having a difficult time this year and over the last few years. You have the healthcare sector, pharmaceuticals not doing so well, and energy sort of flat year to date. But most of these sectors are doing really well. And when you have that scenario, as you move into August, more often than not, August tends to be a bit of a flat month, and September tends to be a little bit more challenging. Our next chart here, which is nicely color coordinated, it shows you, there you have it. Take a look at July. I didn't realize how good the month of July historically is for investors. This is a chart showing the last 15 years or so. Look at how many times the month of July is green. Again, it's in the middle of the chart there. It's only pink, twice. There was one July in 2012 where the gains were just 1%. 2011, we saw a bit of a sell-off, and 2014. So July historically is a great month. You can see the average up top, 2.8%. That is really the second best month to November. November, the average rate of return is over 3%. But let's take a look at August and September. How much pink or do you see on the screen? And you can see that on average, August is slightly negative, and on average, September is almost down 1%. So we're not talking huge numbers or huge numbers to the downside, but definitely something that individual investors need to be mindful of. So as we continue to put more money to work, continue to buy good quality names, you want to continue to look for bargains, but just be mindful where we are in the calendar, where we are with respect to trading, S&P coming into this time of year at all-time highs. And I think you just need to be mindful of that as you make your investment decisions over the next few weeks. So both the Federal Reserve and Bank of Canada will make interest rate announcements on July the 30th. And especially out of the US, we've been back and forth hearing many people speak. If it was up to the President of the United States, he would definitely have or want Jerome Powell, the head of the Fed or the Federal Reserve as a whole, cutting rates at the end of July, and followed by more cuts in the second half of this year. I've heard him recently talk about cutting rates as much as 3%, and that interest rate should be cut 3%. And I think most of us would agree that 3% is too large of a number. Whether or not the Fed cuts maybe twice, 25 basis points each to 50 basis points, or maybe we get 3 cuts totaling 75 basis points, that is more obviously realistic in my opinion. But I don't think they're going to cut in July. There are too many things going against a rate cut. Whereas I think the Bank of Canada here in our country, obviously in Canada, should be cutting interest rates. And we have a few charts to kind of show or illustrate why I think the Bank of Canada should be cutting rates and the US Fed should stay on hold. Our first chart here shows real GDP, US GDP. And so this is really the only thing, in my opinion, that President Trump could focus on with respect to data to show that maybe the Fed should be cutting rates. As you can see here, Q1 GDP was a negative number, negative 0.5%. If we get a second and negative quarter of GDP, then what does that mean? Well, that means the US officially would be in some sort of mild recession. So got to keep an eye on that. We should be getting some data on GDP out of the US shortly. But outside of GDP, everything seems quite strong. Our next chart shows the advance in monthly retail sales, and you can see here how strong retail sales for the month of June was, up 0.6%. Following a weaker May, June was a very strong number. And if you look at the right-hand side of the chart, which is the percent change in retail and food services from the previous month, you can see just how strong June was. So very strong number in June, which tells me that obviously the consumer is very strong and doing quite well. And we know the consumer makes up most of the U.S. economy. Let's look at jobs. Jobs in the U.S. Our next chart, our next illustration, there it is. In the month of June, 147,000 jobs created. But if you look at May, not far off that number. You look at April, once again, not far off that number. Jobs growth, jobs creation has been fantastic in the United States. And to me, it's very hard when you look at jobs growth, when you look at the unemployment rate being just around 4%. Does that mean that the U.S., that the Federal Reserve, U.S., should be cutting rates to stimulate the markets, the economy, to try and create more jobs? Well, you're pretty much at full employment. And that's the mandate of the Fed, full employment and stable prices. And if you have that, that's what the Fed is looking for. On top of low inflation, high jobs, we're starting to see inflation tick higher in the US as well. Our next chart shows this. And you can see on the far right-hand side, you can see both the 2.9%, which is the core rate, getting back up close to 3% again. And you can see the headline number now turning up at 2.7%. Many haven't been anticipating inflation moving higher, and maybe, just maybe, we're finally starting to see that happen. And so going the wrong direction, right? We want to see, or the Federal Reserve wants to see inflation rates down at 2%, which is their target, but now we're seeing the US move more towards 3%. So higher inflation, we're seeing strong retail sales, low unemployment. Is that the recipe for cutting rates for the Federal Reserve? I don't think so. And the hope is that the Fed can keep their independence, can, I guess, continue to weather the storm, if you will. I know President Trump has been very hard on the Fed, trying to get them to cut rates. But I think the Fed should and will stand pat at this point in time. However, Bank of Canada, different story. Our next chart here shows Canada's economy shrinking in April, similar to the United States. So we're seeing our economy flatlining. There really is no growth there. If we go to our next chart, you're going to see that unlike the US moving towards a 3% inflation rate, our inflation rate is 1.9%, below our 2% target. So my question to the Bank of Canada would be, what are you waiting for? Why aren't you cutting interest rates to help stimulate this economy while Canada is having to deal with higher costs and tariffs? I just don't understand why the Bank of Canada doesn't cut rates. Now, I understand that we did have a strong jobs number this past month, over 80,000 jobs created, but a lot of those jobs were self-employed jobs, almost half of them. Not to say that those are bad jobs, but a lot of people today, unfortunately, leave their job that they're working for a business, for a larger business. They either get laid off or leave their job, and they become consultants or they run their own small businesses. And that's great, but that's where most of those jobs came from. We know that big business is unfortunately laying off a lot of individuals, and we're knowing that business in the steel industry has been laying off people, housing industry, even in the banking industry, technology, all the different industries and sectors are laying off individuals. So what is the Bank of Canada waiting for? I asked that question and I will ask it again. And so to me, unlike the Fed not needing to cut rates, perhaps not able to cut rates, I think the Bank of Canada can and should cut rates simply based on where our inflation rate is today, I think is more than enough reason to do so. But on top of that, due to our slowing economy, and as tariffs really take hold in the coming weeks and months, I think it's going to be all hands on deck, and we need to cut rates. NVIDIA to resume chip sales to China. This is big, obviously very big for NVIDIA, but also big for the chip sector as a whole. I think this was the final push for NVIDIA to become the largest company in the world again, passing Microsoft once again, becoming the world's first $4 trillion company, market cap of over $4 trillion. NVIDIA today trading just off their all-time highs. But this is, again, a big thing. And when the United States was striking a deal with China, allowing the U.S. to receive or to get these rare earth elements, these magnets that the U.S. needs for different facets, for different production, different things such as artificial intelligence, defense industry needs it, our phones need these rare earth elements, batteries, etc. This was key because China produces most of what the rest of the world needs with respect to rare earth elements. And in return, we really didn't hear what the U.S. was giving back until recently, which is chips. We're giving back, or I shouldn't say we, the United States is giving a lot of places like NVIDIA to send chips to China, as I'm thinking part of that original deal. And so H20 chips will be sent. I don't think any have been sent as yet. Once the U.S. gives the go-ahead, I think NVIDIA will be raring to go to send the chips to China, obviously increasing their business there, because right now there really is no business between NVIDIA and businesses in China, but it's a very important market for NVIDIA. Our first chart shows a chart of NVIDIA and just how well NVIDIA has done. You can see on the far right-hand side of this chart, the last little blip higher, I believe, has come with the announcement that the China market is going to be reopened to NVIDIA. And even though NVIDIA is going to be sending some of their older chips, not as powerful chips, to China, this is still a very good thing for China because they need these chips. They can do a lot with these chips, as we've seen in the past with DeepSeek announcements and things like that. Even though it's an older chip, it will work just fine. Our next chart, you can see the semiconductor index, the SOX ETF, showing the big gains. A lot of that has been led by NVIDIA, and I really don't see any slowdown in sight. Another chart we have here, which is how much China makes up of NVIDIA's revenues. There it is, makes up more than 12%, quite a bit, down from where it used to be back, I guess, a few years ago, and falling again in it looks like 2025 and into 2026. The predictions that China will make up even less of what NVIDIA revenues are. Our last chart with this segment clearly shows what the chips looks like. Yeah, NVIDIA keeps making new chips for China amid a U.S. crackdown. And, you have here August 2022, which is top left. Biden administration issues export controls for the A100 and the H100. And then NVIDIA introduces an A800 alternative to the A100. And you can see throughout the last few years, NVIDIA keeps trying to circumvent these controls, these export controls, building new chips for China specific, until finally President Trump said, you're not sending anything to China, and now has since reopened chips to China from NVIDIA, reverses the ban. This came just this month, July 2025. So a very crucial moment for the semiconductors. I think AMD went up significantly on the day that the H20 chips were approved by the US government for NVIDIA to ship to China. AMD also has chips that go to China. So the market basically extrapolated and said, well, If Nvidia is going to be able to do it, I'm sure that AMD will as well. And actually, on that day, AMD stock went up even more so on a percentage basis than Nvidia did. So chip makers, semiconductors as a whole, big winners with respect to Nvidia being able to send their H20 chips. And I guess we'll just have to see where trade negotiations go between the United States and China in the future. Perhaps markets will be opened even further. So it's a fact. There's no doubt that investors seem less rattled with regards to inflation starting to move up again in the US, tariffs looking to be implemented on August 1st. If we had seen, or when we did see, I should say, these things happening earlier in the year, market sold off and sold off strong. For all of you watching, we can all remember what the markets looked end of February, March, and I guess really hit a bottom in April. And times were difficult. We didn't really know where things were going at that time. The president talked about these tariffs, a part trade negotiation, but that these tariffs were all going to be implemented and were going to stay. And then shortly after, we started to hear that trade negotiations were going to happen. But once again, we're starting to see tariffs announced, letters being sent with these tariff rates, but yet the market doesn't in their current form. At some point in the near future, tariff or trade deals, I should say, will be done and negotiated. Our first chart in this segment shows the S&P 500. Again, what the interesting thing on this chart is, even though it is a 6-month chart of the S&P, you can see pinpoint exactly when the reciprocal tariffs were announced, and look how much the markets went down just after, and really went up again a little bit and then right back down. And it wasn't until May where we started to see things get a lot better, when the United States government said that they would begin to negotiate. The next chart shows inflation. When inflation was back in and around 3%, when CPI was back in and around 3%, hard to see the market sell off a little bit here, although you did see a sell-off, I guess, back in February. You saw the market selling off with a higher inflation rate. And even most recently, you are seeing the market move higher, but it's been a little choppy, a little choppier. We've seen the markets move higher for the months of May and June and most of July. And we'll see. We'll see if inflation gets above 3%. We'll have to see what the markets do. Right now, it looks like CPI is approaching 3. Nobody is talking about that as a problem. Everybody is saying that, yes, inflation is higher, but it was expected. And I'm not sure what that means. Why is it expected now in July, but it wasn't expected back earlier in the year? So again, it's all about the news. It's all about interpretation of the news. You know, someone told me one time, there's no such thing as good or bad news. It's just news. And whether it's good or bad is how you interpret it, is how investors interpret it, is how the markets interpret the news. And I really believe that. So some days you could see bad news, the markets go up. And on some days, the good news, the news is interpreted by some as good, and yet the markets sell off. And it's all in the interpretation. And I guess as investors, it's hard to get around that. It's hard to invest through that sometimes. But I think if you take an even keel, not get too high, not get too low, it's much easier to understand the ups and downs of the market. And over the long term, if you own good quality, we know that good quality always rises to the top. Quick hits. 3 things that we've seen in the news recently that I want to comment on. Some things that I'm sure many of you have seen. Our first one, global oil market is oversupplied. I've been saying this for a long time. We're hearing OPEC continuing to increase production. That, along with the U.S. trying to increase production. You know, Iran is back, was not taken offline by the war in the Middle East. We know Iraq continues to produce. There doesn't seem to be a slowdown anywhere. And yeah, oil market oversupplied. We'll talk a little bit about that. Bank of Canada says inflation expectations are actually easing as businesses hold off passing tariff rates on to the consumer. Interesting. We saw that from GM the other day, talk about how they're swallowing some of the higher costs so that the end user or consumer is not feeling the higher prices. U.S. firms scrambling to secure rare earth magnets. Imports from China surging 660% recently. I guess that's because when things get turned off, you got to play catch up. And I think that's what's happened, and that's what we're seeing with our third point. So let's move to our first quick hit, which is the global oil markets. Our first chart here, pretty simple, shows the oil market, shows that it had a blip during the I guess the Middle East war, the war in the Middle East between Israel and Iran. We saw a spike higher, but then once the war was over and we saw a ceasefire, that war premium came out of the price of oil, and oil has been okay, just above $65 a barrel for a little while. But I think there is a good possibility to see oil prices move lower as production remains high, as OPEC production increases, and as the fear premium that we've seen in some of these areas around the world comes out. And I think there's a lot of oil in the world today. Oil is produced. Yes, we could see some more growth in China, some more growth out of the U.S. with some of the U.S. policies. So perhaps that will be a positive for oil prices. But make no mistake about it, President Trump wants oil prices to fall, and he's going to do whatever he can to make that happen. And so for me, I think the price of oil is going to come down, I think below $60 a barrel shortly. Our second quick hit is the idea of the Bank of Canada saying inflation expectations are easing, which is interesting because we would have thought that prices would be going up. I think overall prices are going up, but businesses are doing whatever it takes to swallow as much of the increase as we can. And we are seeing margins be squeezed at a lot of these businesses. Our first chart shows Canadian firms indicate future sales are weak. So yes, we may not be seeing prices rise, but we're definitely seeing that sales are slowing down for sure in Canada. Obviously, the tariffs are taking having a toll, taking their toll on our economy and sales. Our next chart just shows you exactly how many firms and they're absorbing the tariff costs through their margins. And this is a great chart, actually, probably my favorite for the show. How is your business reacting to cost increases from trade tensions? Share of firms that said they are facing higher costs. And what are they doing? Well, some of them are reducing margins, finding efficiencies, changing prices for Canadian consumers, changing prices for U.S. consumers, finding new non-U.S. customers, and changing suppliers. So this is how many of Canadian businesses or many of the businesses in Canada are coping with these high tariff rates. Our third and final quick hit deals with this idea of the firms scrambling to in the U.S. to pick up rare earth magnets, rare earth elements. And really, I think it's just about China was shutting out U.S. for a little while there. And so the backlog of rare earth elements was quite large. And now that China is back shipping rare earth magnets to the U.S., we're seeing a surge, quite a large surge. Our chart that we have, the one chart for this really shows the surge. Exports to the U.S. tumbled in April and May, but you can see here how they've surged in June. Not back where March was or February or even January, but really starting to pick up. And again, I think that the U.S. traded, I guess, or during the negotiation said, we'll give you chips if you give us these rare earth elements. And I think that was the deal in some form. And now we're seeing it come to fruition. And the rare earth elements, once again, are being shipped and taken in by the United States in quite a large quantity. Now the part of the show where I take at least one question from our audience. I always like to pick one, sometimes a question that we didn't talk about during the show. And we actually got one a couple of days ago from a watcher, perhaps even a listener of the radio show. And it reads, how should I balance paying off debt with investing for retirement? Should I focus on eliminating the debt first? A great question, and I guess a very common question I get. It all comes down to what is the interest rate you're paying on your debt. If you're able to have a low interest debt, something that's in the 2 to 3% range, then yes, it might make sense. Quite often, it makes sense to invest, because if you're buying good quality investments, as we've seen over the last few years, investors have made a lot more than 2, 3%. However, if your interest rate is much higher, 4, 5, 6%, well, now you're starting to get into a different area. And even though, yes, investment returns have been higher, their 6% interest on debt is starting to get high. And at that point, I would say you probably could do a bit of both. Maybe invest, maybe pay down some of the debt, maybe not all of it, but invest some. I never want to see people taking, or investors taking, all their money that they have in investments and paying down debt. As I said, as long as debt is manageable, as I tell investors all the time, as long as the interest rates are manageable on the debt, you can continue to have debt. There's nothing wrong with that. However, if you are still making good returns in the markets, it definitely makes sense. If you are in a portfolio of bonds making 3, 4%, then of course you're paying more on the debt than you're actually making, and that doesn't make sense. So if you can get a low interest rate on your debt and invest instead of paying it off, that is definitely the recipe for success. So with that, I want to say thank you to everyone that tuned in today. As always, I hope all of you took away something from our show. I want to say thanks to Catherine Cobden for being on our show and shedding some light on the situation with respect to steel tariffs. And I guess until our next show, which will happen in 2 weeks' time, 12 noon, as usual, on Wednesday, across all social media platforms. That will be on Wednesday, August the 6th. And until then, happy investing.